Ever wondered which is a better investment, unit trusts or stocks? Welcome to the Learning Corner, the place where financial dreams take flight and where the savvy investor can transform a modest sum into a fortune. If you're new here, we extend a warm welcome to you. Today, we're going to break down two of the most popular investment options available to us, unit trusts and stocks. Unit trusts are often viewed as the safer bet, as they pool together funds from a multitude of investors to invest in a diversified portfolio. Stocks, on the other hand, while potentially more risky, hold the promise of higher returns. Both these investment options have their unique advantages and operate differently in the market. Our goal today is not to determine a clear winner, but to delve deep into these concepts, understand their unique characteristics, and illuminate how they can be incorporated into your investment strategy. Whether you're an experienced investor or just beginning to explore the world of finance, we have something insightful for you. And if you find the content of this video helpful, please consider subscribing to the channel and don't forget to share, comment, like. Stay tuned as we delve deeper into these two popular investment vehicles. First up, let's unravel the mystery of unit trusts. Imagine you're part of a group of friends who decide to pool their money together to invest. Each of you contributes a certain amount, and the total sum is then invested in a variety of assets. That's essentially how a unit trust works. It's an investment scheme where multiple investors combine their capital into one large fund. But here's the twist. Instead of managing the investments yourselves, you appoint a professional known as a fund manager. This expert, backed by a team of financial analysts, handles the daily decisions about where to allocate this pool of money. Their goal is to build a diversified portfolio that aligns with the trust's investment objectives, balancing both risk and reward. Now, the pooled money is divided into units of equal value. As an investor, you buy these units. The number of units you hold represents your proportion of the overall fund. The value of each unit increases or decreases based on the performance of the investments in the portfolio. So, what are the benefits of unit trusts? 1. Diversification. Your money is spread across a variety of assets, reducing the risk of losing everything if one investment fails. 2. Professional management. You're leveraging the expertise of industry professionals who have the knowledge and experience to make informed investment decisions. But remember, there's no such thing as a free lunch. Risks are part and parcel of investing. The value of your units can go down as well as up, depending on market performance. Plus, you also need to consider the fees and charges associated with unit trusts. These can eat into your returns, especially if the fund doesn't perform well. Also, unlike stocks, unit trusts don't give you ownership rights in the companies you invest in. You can't vote at shareholders' meetings or have a say in how the business is run. So that's a quick overview of unit trusts. But what about stocks? Now it's time to demystify stocks. Let's start with the basics. Stocks, also known as shares or equities, represent ownership in a company. When you buy a stock, you're purchasing a piece of that company, making you a shareholder. You're now part owner of the business and have a claim on its assets and earnings. Stocks are traded on stock exchanges, like the New York Stock Exchange or the London Stock Exchange. These are essentially marketplaces where buyers and sellers come together to trade stocks. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Now, why would you want to invest in stocks? There are two main benefits. First, you can earn money through capital appreciation. This is when the price of a stock you own increases over time. If you bought a stock for $20 and it's now worth $50, you've made a profit of $30 per share. Second, you can earn money through dividends. These are portions of a company's profits that are distributed to shareholders. Not all companies pay dividends, but those that do can provide a steady stream of income. However, investing in stocks is not without risks. The price of a stock can go down as well as up, and there's always the possibility that you could lose your entire investment. Stocks are also affected by market volatility, which is the rate at which the price of a stock increases or decreases for a set of returns. It's important to note that higher volatility often means higher risk. That's stocks in a nutshell. But how do these two investment vehicles compare? With a basic understanding of unit trusts and stocks, let's compare them. When we look at risk, unit trusts and stocks are fundamentally different. Unit trusts, being diversified investment vehicles, tend to minimize risk by spreading investments across a wide array of assets. This diversification reduces the impact of any single poor-performing investment. On the other hand, investing in individual stocks can be riskier. The performance of your investment is tied to the success of a single company, and if that company doesn't do well, your investment could take a hit. Now let's talk about potential returns. Stocks can provide high returns if you pick the right company at the right time. However, they can also lead to significant losses if the company underperforms. Unit trusts, on the other hand, often provide steady, though generally lower returns over time. This is due to their diversified nature, which can cushion against dramatic market swings. In terms of costs, unit trusts usually come with management fees, since they are actively managed by fund managers. These fees can eat into your returns over time. Stocks, on the other hand, generally involve lower costs. You may pay a commission when you buy or sell, but you won't have ongoing management fees. Next, let's consider liquidity. Both unit trusts and stocks score high on this aspect. In most cases, you can buy or sell both on any business day. However, the transaction process for stocks is usually quicker, with trades often settled on the same day. For unit trusts, it might take a few days for the transaction to be processed. Finally, the level of expertise needed to invest in these options varies. Investing in stocks requires a deep understanding of financial markets and individual companies. You need to research, select, and manage your own investments. Unit trusts, on the other hand, are managed by professional fund managers. This makes them a more accessible option for those who lack the time or expertise to manage their own portfolio. So, there you have it. Unit trusts offer a lower risk, diversified investment option with steady returns, but they come with management fees and require less personal involvement. Stocks can offer higher potential returns and have lower costs, but they also carry higher risk and require a significant level of expertise. As you can see, both unit trusts and stocks have their own unique features, benefits, and risks. So, which is a better investment, unit trusts or stocks? As we've journeyed through this video, we've explored the intricacies of both unit trusts and stocks, dissecting their features, benefits, and potential pitfalls. By now, it's clear that both have their unique merits and drawbacks, and the choice between the two is not simply a matter of black and white. Let's recap. Unit trusts offer diversification, professional management, and relative safety, making them ideal for those who prefer a hands-off approach. They are a great way for beginners to dip their toes into the world of investing without having to navigate the complex labyrinths of the stock market. However, their returns might not be as high compared to stocks, and the management fees can add up over time. On the other hand, stocks can offer potentially higher returns, and they give you direct ownership in a company, which can be a thrilling prospect for those who relish the idea of directly participating in the market. Yet, the risk is higher, and it requires a more active approach and a good understanding of the market. So, which one is better? It all boils down to your personal circumstances. Are you a risk taker or a safety seeker? Are you looking to build wealth over the long term or seeking quick returns? How much time and effort are you willing to put into managing your investments? These are the questions you need to answer before deciding which investment is better for you. The beauty of investing is that it's not a one-size-fits-all affair. It's about finding the right fit for your financial goals, risk tolerance, and investment knowledge. And remember, investing is not a sprint. It's a marathon. It takes time, patience, and a well-thought-out strategy to build wealth. Remember, it's not about choosing the best investment, but the right one for you. Thank you for watching, and happy investing.